My name's Bob Campion. I'm publisher and editor-in-chief of Engaged Investor and Pensions Insight magazines, and I'm here today with Jim Trotter, Head of Performance and Risk at Northern Trust, to consider some of the ways that trustees can improve the way they manage and monitor risk and performance measurement. So Jim, a lot of trustees find it difficult to keep track of their performance of their funds and their investments in between the normal quarterly meeting cycle. What can you suggest as ways they can improve that?
Thanks, Bob. Well, I think that's always been a challenge, and I think given the financial markets and what's happened in the last 2 or 3 years, and plus looking at pension funds now and the diversification of assets, you can see why it's becoming more and more of a concern. There's a number of things you can do. Some of the areas we try to focus on are, and really it depends on what the trustee themselves, want access to and whether they want direct access themselves, but generally we would make sure that in between those meetings, whether it's on a monthly basis, for example, provide them sort of updates at a very high level sort of fact sheet type information rather than a trustee or investment committee type report. Or more and more clients and some trustees are coming and asking for access to our online capabilities where they could in effect look at their valuation of their scheme as of yesterday, really, if they truly wanted to get to that level of detail. So depending on the need from the trustee and the type of information they want to access, then really there's different channels we could take to do that.
In the UK, Jim, trustees have experimented with a range of different ways of monitoring their performance using scheme-specific and peer group benchmarking. But what do you think is the best way they can go about managing the performance of their investments or the overall scheme?
Well, I think where we are now in terms of what pension funds do, we're in the right place or a much better place. The focus, without a doubt, in the UK market, 20 years ago, 10 years ago, 5 years ago, still was peer group driven, sort of follow the herd mentality. I think that really didn't work in the sense there was too much focus just on the assets and comparing those assets to peer groups. Very much now, if you look in the financial press every day, people are talking about liabilities rather than assets. So pension funds adopting custom and strategic benchmarks that are very much driven by those liabilities, and then monitoring their managers and their scheme against those more appropriate benchmarks and targets, I think is the right place to be. There's still a role for some funds and for some markets for peer groups. I think it's used still as part of the manager selection process, but again, there's pros and cons to do that because research and history tells you that you look at a peer group analysis for your UK equity mandate, you see the manager that's the top, you decide to pick that manager, and lo and behold, they then become the bottom manager for the next 3 years. So, peer group's got its uses, but definitely not as the primary benchmark for pension funds anymore.
Now, we've talked, Jim, quite a lot about performance, but what about risk? When it comes to measuring and monitoring risk, what sort of things should trustees be thinking about?
Okay, well, I think along similar lines in a sense to in the past, performance measurement was very much about the assets. It's now about assets and liabilities. Given what's happened in the last 2 to 3 years in the financial markets, risk is much more now than just investment or market risk, so traditional risk measures that would normally be presented to trustees. Words such as counterparty, credit, liquidity, even operational, concentration risk, all of these are a range of risks that the end trustee, I don't think has to be necessarily aware of to the nth degree, but they're things that, again, through their gatekeepers, such as their head of pensions or the investment committees, they need to be actively monitoring. Yeah, so again, the starting point from a risk perspective, I'd say there's 3 or 4 levels to it. There's a scheme level, your assets versus liabilities, and are you underfunded or not? So that's the starting, overall arching sort of risk from a scheme perspective. Then you can look at, from a risk budgeting and diversification point of view, you've worked out your strategic benchmark, you've got your assets, this is how you're doing against your liabilities, and this is how you've broken down your asset allocation to give you diversification. Is that still working? Is it still meeting your liability requirements? Thirdly, there's the traditional sort of manager monitoring from a risk perspective. So again, traditional risk measures, whether it's active risk, value at risk, all the sort of the terminology that people would generally be familiar with. But the fourth and important area that I think more and more pension funds and trustees are becoming much more active in asking about is things as basic as concentration risk. So how much do I have in this sector or with this manager? counterparty risk. So yeah, I hold the stock Merrill Lynch, but through other other exposures, whether it's an OTC and Merrill Lynch are the counterparty, what is my overall exposure to that asset, and areas such as liquidity or credit risk. So is Merrill Lynch about to be downgraded? What does that mean for my portfolio and my overall asset v liability structure?
And overall, Jim, what can trustees do to improve the way they manage and monitor risk and performance?
In a sentence, keep it simple. Now, what I mean by that is there's a lot of information out there, information overkill. So it's really trying to focus on the information that's important. At Northern Trust, we've tried to build a concept of giving client dashboard type reporting. So if you're a head of pension, this is what you should focus on. If you're a CIO and we're supporting you in fund management community, this is what you should focus on. Not just focus on performance measurement, which historically I think trustees have spent more of their time probably from an analytical perspective. We've talked about risk. Ask as many questions and look for information on counterparty exposure, on concentration exposure, on credit issues. So start asking those sorts of questions. And at the most sort of sophisticated end of risk, when we try to predict what's going to happen in the future, which nobody can do, is embrace some analysis around that as well, because really the past is the past and you've got to be trying to manage the future as well.
So I think we've got a really good insight there into some of the practical ways that trustees can improve the way they manage and monitor risk and performance. So big thanks to you, Jim, for your time. Thank you very much.
Thanks for your time as well, Bob.
And please keep watching this website for more videos in this series with Northern Trust.